Hello, everybody. Welcome to my solution walkthrough for problem 6-1 from Intermediate Accounting 17th edition textbook. Authors Don Kiso, Jerry Weingan, and Terry Warfield. The question used in the presentation is copyright by 2019 by John Wiley and Sons, Wiley. All rights reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions contained in this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. I need to make this 2022, so just give me a quick moment. Because it is the new year. Happy New Year, everybody. Have a very safe and fruitful 2022. Okay. So we're doing problem 6-1, which is going through and looking at various different time value situations. So let's take a look at letter A. On January 1st, 2020, Fishbone Corporation sold a building that cost $250 and had accumulated depreciation of $100,000 on the date of sale. Fishbone received as consideration a $240,000 non-interest-bearing note due on January 1st, 2023. There was no established exchange price for the building, and the note had no ready market. The prevailing rate of interest for a note of this type on January 1st was 9%. What amount should the gain from the sale of the building be reported? Okay, so the first thing we're going to do is when we go through and compute a gain or a loss as of a sale of an asset, is we're going to have a loss, balancing, accumulated depreciation, cash. In this case, it's going to be a note, equipment, and we're going to have a gain, balancing. Okay, so over here, right, instead of getting cash, what we're going to be getting is essentially we're going to be getting a note receivable. But this is a very important equation when we're going through and recording when we dispose of equipment. So our equipment had a cost of $250,000. Okay. And then the accumulated depreciation on that building was $100,000. And so now instead of cash, what we're going to be receiving is we're going to be receiving a note receivable. The note receivable has a value of $240,000. However, there's a problem. Is it really worth $240,000? And the answer is no. Why is it not worth $240,000? The answer is that $1 today is not the same as $1 tomorrow. So what we have to go through and figure out is what is going to be the discount on the note receivable for this particular piece for this note. So again, we're getting a note, right? But we're right now for Fishbone in this problem part A, we're on 1/1/20. Right? When are we actually going to get the money? Well, 1/1/21, 1/1/22, 1/1/23. So we're not going to be getting this note for a total of 2020, 2021. We're not going to get this note for another 3 years, right? So 3 years basically from January 1st, 2020. So what we have to do is because we're going to be getting this $240,000. Let's just make it a little bit easier on ourselves. We'll just say this is on 12/31/22, 12/31/21, 12/31/20. Let's make it a little bit nicer. So we've got basically $240,000. What is this value of this note today? Well, what we have to go through and do is we have to say, well, the amount that we're basically going to be getting in 3 years is going to be $240. So what I have to do is I have to bring that back into today's dollars. So this is going to be present value of $1, 3 periods, because that's how many years away it's being paid to us at a total of 9%. So what I'm going to do is I'm going to go to my present value of $1 table, and I'm going to go to 3 periods at 9%. And I'm going to get something telling me that I need to get better reading glasses. Folks at home, this is what will happen to you over time. So right over here, number of periods, 3 at 9%, I get 0.77218. When I multiply this through, I get 185,323. So over here, so this is basically the present value of the 240 in today's dollars. So my discount amount is going to be the note receivable less this 240 in today's dollars. So my discount on the notes receivable is going to be 54,677. Now, what's going to happen is that every single year I'm going to be going through and I'm going to be recording interest revenue, right? I'm going to basically debit the discount on the note receivable. I'm going to credit interest revenue based on the carrying value of the note. So now that I've gone through and I've done this part over here, we now have to ask ourselves the question, do we have a gain or a loss? This is why I love to use this equation for these particular types of problems, because it helps me go through and figure it out. So over here, I've got 340 of debits, 304,677 of credits. What do I need to do to balance? And I need 35,323. There we go. So whatever I need to do to balance, that is going to be my, in this case, it's going to be my gain. Okay. So another way of looking at this, I had a book value of my equipment of 150, right? I'm getting a note. The note value in today's dollars is 185,323. So I'm going to have a gain of 35,323. So that's letter A. Okay. So letter B, on January 1st, 2020, Fishbone purchased 300 of the $1,000 face value bond, face value 9%, 10-year bonds of Walters, Inc. The bonds mature on January 1st, 2030 and pay interest annually on beginning January 1st, 2021. Fishbone purchased the bonds to yield 11%. How much did they actually pay for the bonds? Okay. So let's kind of think about this here. I got three, so I've got $1,000 face value, and I bought 300 of these. So the amount that I'm going to be recording as basically as an investment in bonds is going to be over here at 300,000. Okay. So, however, I did not pay that particular dollar amount. I basically bought the bonds to yield 11%. So what we need to figure out is the two components of the bond. The first one is going to be, and how do we go through and value a bond? There's going to be the interest payments, because every single year, how much are we going to be receiving? Well, the amount of interest we're going to receive is going to be 300,000, which is the total value I have, or the total amount of the bonds times 9%, or I'm going to be receiving $27,000 per year. Another way to look at this is that if you're getting 90 bucks a year, you own 300 of them, 27,000. There you go. Okay, now for the interest, God, my spelling is interesting, Bennett. So my interest payments. So for my interest payments, the way I'm going to value this is I'm going to take the present value of an ordinary annuity of $1. Okay. And so the way I'm going to do this, I'm going to take the present value of an ordinary annuity of $1. And this is basically going to be 10 periods at 11%. And by the way, I'm not actually going to show the bonds here at the face value. I kind of screwed this up, but this is the total amount that I had over here, and I'm going to explain why in just a moment. So my interest payments, 27,000, present value of an ordinary annuity of $1. Why am I using this table? Because every single year, I'm going to be paid $27,000 per year. For this, I'm going to go ahead and use the present value of an ordinary annuity of $1. Now, this is going to be 9. I'm purchasing them to yield at 11%. So I'm going to go over here, present value of an ordinary annuity of $1, 10 periods at 11%, and I'm going to get 0.5 5.88923. So the present value of the interest payments, this is very interesting, isn't it? Ha 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 ha. My terrible, terrible accounting humor. Okay, is going to be right over here at 159,009. Now, what else does the bond have in value? Well, at the end of 10 years is going to be paying me the principal payment. Remember, a bond functions like an interest-only loan. I'm getting interest every single year, and then at the very end of the period, I'm getting the lump sum. Now, for this lump sum, I have to use present value of $1 because it's one single payment, right? Annuity, multiple payments, same dollar amount, single dollar amount that's being paid in the future. I use present value of $1. I use the same factor, 10 periods at 11%. I come over here, 10 periods at 11%. I get 0.35218. All right, 0.35218. So the present value of the principal is going to be 105,654. Okay, so the total amount, how much did Fishbone pay for the bonds? Okay, so basically you got the present value of the interest, present value of the principal. So the total paid, part B, total paid for the bonds is going to be 264,663. The way you would record it is you would show a investment in bonds payable, and then you would be crediting cash for the amount of the investment. Okay. Okay, let's take a look at letter C. Moving right along. Fishbone bought a new machine and agreed to pay for it in equal annual installments of $4,000 at the end of each of the next 10 years, assuming an interest rate of 8% applies to this contract. How much should Fishbone record as the cost of the machine? Okay, so right over here, so I bought a new machine and agreed to pay it equal installments of $4,000 at the end of each of the next 10 years. Okay, so we've got years 1 through 10. Right, so I'm paying $4,000 per year. Don't try this one at home, kids. So I'm paying this $4,000 per year. And the question now becomes, well, what this clearly is not, as I go through and I look at this, the value of the equipment is not, 4,000 times 10 or $40,000, rather, because these payments are being made in the future. So what I'm going to do is I'm going to have the payment amount. My payment amount is $4,000. I'm going to go to the present value of an ordinary annuity of $1, and this is going to be 10 periods at 8%. Okay, so right over here, 10 periods, 8% is 6.71008. Okay, so right over here. Okay, so right over here, I'm going to take 4,000. I'm going to multiply that by 6.71008. I'm going to get 26,840.32. So how much should I record as the cost of the machine? It's going to be this amount right over here, 26,840.32. How would I actually go through and record this actual transaction though? So I'm going to have equipment over here of 26,840.32. I'm going to have a note, or what do I call this one? Call it a note payable. Sounds good. I'm going to have a note payable. My note payable amount is going to be for 4,000 times 10, or the total amount that I owe. That's what I need to show on my financial statements. But the difference over here is going to be a discount on notes payable, or 40,000 minus 26,840. This really kind of represents the amount of interest that's implied in the transaction, but this is how I would be going through and showing it. Okay, so this is how I would do. Obviously, I need a date, I need a description, but this is going to generally be the journal entry. Okay, Fishbone Purchase Corporation purchased a special tractor. I guess it's special. On December 31st, 2020, the purchase agreement stipulated that Fishbone should pay $20,000 at the time of purchase and $5,000 at each of the end of each year for the next 8 years. The tractor should be recorded on December 31st, 2020, at what amount, assuming appropriate rate of interest of 12%. Okay, so we know that for part D. All right, so right over here, I'm just going to hide this for a little bit. Go into hiding. Okay, so for part D over here, right, I paid for a new machine. I basically paid 20 grand, right? However, the 5,000 is not 5,000 for each of the next 8 years is not the same as 5,000 today. So my payment amount is going to be 5 grand. And then what I'm going to do is I'm going to go to the present value of an ordinary annuity of $1. And this is going to be how many times I'm making the payments, or 8 periods at 12%. So come over here, 12%, 8, basically, I'm sorry, 8 periods of 12%. Good job, Bennett. Right over here, I get 4.96764. So 4.96764. When I multiply these through, I get 24,838.20. So the actual amount that I want to record for this special tractor, right? So this is part D. So this is my down payment, present value of the future payments. So I'm going to get a total over here of 44,838.20. If I were to go through and record this, I would say equipment. So my equipment, or the special tractor, would basically be over here at 838.20. I'm going to basically over here, I'm going to credit notes payable over here for 5,000 times 8, or 40,000. I'm going to credit cash because remember I made that down payment. Okay, so right over here. And then my discount, my difference is going to be a discount on notes payable. Wow, great spelling, Bennett. Payable, there we go. Okay, so 60,000 minus 44,838.20, and I'm going to get a discount on notes payable of 15,161.80. So essentially, what I'll do is, as I make those payments, I'm also going to be recognizing interest expense. So, and that will be against the discount. Okay, so letter E. I want to withdraw 120,000 from an investment fund at the end of each year for 9 years. What would be the required initial investment at the beginning of the first year if the fund earns 11%? Wow. Okay, let's just kind of think about this one. So Fishbone wants to withdraw 120,000, including which includes principal, from an investment fund at the end of each year for 9 years. What would be the required initial investment at the beginning of the first year if the fund earns 11%? Okay, so this is kind of a funky one. So if I go here and I say, all right, +1. Okay, so I've got here 120,000. I'm going to be withdrawing every single year for 9 years. So really what I'm kind of asking myself is, what's going to be the amount of the initial investment if at the beginning of the first year the fund's earning 11%. So what I would want to do here is take 120,000, which is going to be my payment or the annuity. Okay. And I want to bring that back into today's dollars. So I'm going to use basically present value of an ordinary annuity of $1. And we're going to basically say, you know, actually, this is wrong. Actually, let's just go with it. Present value of ordinary annuity of $1. And we're going to say over here, 9 periods at 11%. Okay. So let's take a look. 9 periods at 11%. 9 periods at 11%. I get 5.53705. And the amount over here I'm showing is 664,446. However, I don't think that that's right. There's something wrong with my analysis here. Just give me a moment. My answer actually is right, but I want to kind of prove something to myself because I want to kind of better understand this. So let's kind of take this through. So let's take the amount invested. And we'll do this over 9 years. Let's just have some fun just to make sure that what we're doing is right. Okay. Okay, so my amount invested is 664,446. So I'm going to pay interest on this. It's going to be 11%, right? So this is going to be every year. And so my interest earned is going to be 664.46 times 11%. So my principal plus interest is going to be 664,446 plus the 73,089. My withdrawal is 120,000. And this is going to be happening each over the next 9 years. So my ending balance is going to be the principal plus interest minus the 120 or 617,535. So that then would become the beginning balance of the following period. And we would go through and kind of do the same parts over here. And there we go. It actually works. So I kind of like doing that sometimes if something doesn't really make sense. But as you can kind of see, this actually works. So if I invest 664,446 today, it earns 11%. So I get interest of 73,089. So the value of the principal plus the interest is 737,535. But I take out 120. When I take out 120, my ending balance is now going to be 617,535. That becomes my beginning balance for the following period at 11%, and so on and so on. So there you go. Thank you for joining me here today on this never-ending accounting journey as we go through the Keystone Wind Down textbook. And I want to thank Wiley for allowing me to use their problems and questions, or exercises, conceptual analysis, and whatever else they want to call it. Don't forget to like and subscribe. And if you want other solutions, please feel free to ask for it in the comments. Have a great one, and I'll see you on the next video.